At the end of last year, I made a video looking at what investors might expect from 2013. After 2012 turned out much better than expected, I said most experts believed we were past the worst. The three big risks of a collapse in the euro, of recession in China and a financial crisis in the US had receded, I said. The big risk was not to be positioned for the economic growth we might start to see in 2013. Well, 3 months on, how have we done? Was I right? Are stock markets healthy? As there's a medical theme to this, I thought I'd come to the grand headquarters of the doctors' trade body, the British Medical Association. If I was a doctor, I'd say that on the evidence so far this year, stock markets are definitely alive and kicking. Investors who were too defensively positioned in cash and bonds at the start of the year have been kicking themselves after stock markets have enjoyed a tremendous start to the year. In January and February alone, UK investors enjoyed double-digit returns in world equities or shares. The UK's FTSE 100 soared nearly 9% and the Dow Jones Industrial Average Index advanced a similar amount to hit an all-time high by early March. So, are we out of the woods? Is the financial crisis behind us? And is it time to pile in? Well, the answer to these questions are firmly no, and yes, it is a good time to invest as savings rates are rubbish, but don't throw caution to the wind. You see, if I was a doctor and the stock market was my patient, I'd be concerned that he or she had rushed back to work too soon. The recent manic behaviour we've seen in the stock market has all the hallmarks of a person who jumps up at the first sign of feeling better and wants to climb Mount Everest. A relapse is quite likely. While I was right 3 months ago to say that the mood music around the stock market was increasingly positive, I was a bit hasty to link it too closely to an economic recovery. The stock market rally we've seen this year is not the result of a sudden brightening in economic prospects. This year already we've seen the UK stripped of its AAA credit rating by one of the leading agencies. Moody's did this because our economy is struggling to stay out of recession and our debts are not going down. Meanwhile, the outlook for Europe is dire, although Germany is doing much better than France, Italy and Spain. This statue to Mahatma Gandhi, the man who did so much to lead India to independence, is a reminder of the idea of economic self-sufficiency that underpinned much of his thinking. I'm pretty sure Gandhi would have been unimpressed with the mess we've got into today. The fact is, the stock market rally we've seen has been the result of central banks like the Bank of England and the US Federal Reserve keeping interest rates at all-time lows while pumping money into the financial system. In other words, our economies are still on life support because the central bankers are worried that the debts under which we labour will drag us back into recession. Looked at this way, the stock market rally is disturbing because it is not based on economic fundamentals. The stock market bulls, for example, have ignored the impact that US government spending cuts will have on the world's largest economy later this year. That's not to say there aren't any silver linings in the clouds. The dramatic fall we've seen in the value of the pound this year has actually made it easier for UK investors to invest overseas. Meanwhile, China, the world's newest superpower, does seem to have avoided an economic hard landing and under its new leadership should emerge towards more sustainable growth. It's been great to see stock markets start off so well, but as always in investment, it's important to keep a sense of proportion and balance. Stock markets rarely rise in straight lines and there will be setbacks, so invest for the long term and spread your money around a diverse range of countries and asset classes.